Hello and welcome back to this course on working capital management. Working capital need for every company is different. It depends on the business model, it depends on the seasonality, it depends on the financing capabilities available to the company. It also depends on the industry nature, right? As we have seen already in the previous slide that the working capital of different industries is different. The cash conversion cycle is different. So how does it different? What are the concepts in that? Let's look at that now. The working capital needs in different companies can be different. For a stable company, you need money for initial working capital, initial capital for fixed assets, that's fine. And then you need a permanent working capital because the company is stable, your requirements may not change. The working capital requirement may grow slowly because of the company growth, but that's fine. You can always finance that because you have a higher growth rate and higher cash reserve as well. But for a seasonal company, the working capital requirements may change from each month, right? For example, hotels. In low season, you have your operating expense are very low, but your income is very low, but your cash expenses are still high because you have to pay fixed labor costs, fixed utility costs. So your working capital requirements will be very high, right? Because you are not getting any money. Plus, in the high season, your working capital requirements may not be that much because you have quite a fast of income. Your account receivable will be very slow. Your inventory turnover is very fast and you are able to generate a lot of cash immediately. So that in that case, your working capital requirements may reduce for running the operations. So you may not need that much of working capital. However, in the low seasons, you may need much higher working capital. So in that case, the management of working capital will be different, right? Because you need you need to have a fixed capital, and then you need to see minimum what are the working capital spikes. So here you have permanent working capital, plus you may have certain spikes because of your seasonality. So in this case, it's pretty much difficult to and requires effective management, much more robust management of working capital because of the seasonal requirements. So what are the different policies to manage in these scenarios? When you have fixed thing, then you can just take a permanent working capital and forget about it, no issues. Means you take the loan or you have a stable credit facilities from your suppliers, and then you can manage it. But if you have seasonal requirements, having a high working capital may be a choice. So you have two policies. One is to get the maximum loan, maximum facilities for to comply with your maximum requirements here, which means on some time you will have excess working capital, means you have excess cash lying in your requirement. So what will you do? You will put them into the marketable securities to manage the to get some kind of returns, right, to higher cash. Another way is, which is more aggressive way, is you maintain only the minimum one, and then whenever you need the money, you buy the short-term money. So in that case, your financing cost may increase, right? Now there is another way to manage it, which is more on a like a compromise way, where you can average it out and then say, okay, let me manage it this way. So compromise policy, in some I manage it here. Some months we need to borrow money because we are short. Some months we have extra money, so we will put them into the marketable securities. So this way you can offset the shortage with the excess in another month and try to maintain your working capital. Now this is a recommendatory way. The companies need to understand their working capital requirements. The companies need to understand what are the seasonalities in their business, so that they can easily understand and make a compromise, make a policy for the working capital management. This is a pretty much requirement for the working capital management. Now from the next session, we will be looking at individual components of working capital and how do we manage them